Thank you so much for putting us on, for having me. I must admit I haven't done a proper Teams presentation in a while, so I can't see you, but just see my full screen. So we have a protocol in place for questions, and so don't hesitate to interrupt me. And also I appreciate you with all the things going on in Israel at the moment. I'm grateful that you take the time to listen to our work, which is joint work with Max, who is online again, I think, but I can't see him. But Max, if you want to make yourself known, then that's great. And Oscar and Alan, an old team of co-authors and friends, and Max is a fantastic PhD student at Bonn, hitting the market next year. Our paper is called Loose Monetary Policy and Financial Instability, and it is, hang on, yes, it moves. It is, I think, one of these papers where luckily there isn't, you don't need much of a motivation or much of an introduction, in the sense that the question whether a loose stance of monetary policy, low interest rates, however defined, are related to financial instability, financial crises, boom bust in asset prices and credit markets, is one that, at any given week you open up some newspaper, you will most likely hear someone talking about it, or some business person or some banker or someone warning of the implications. It was very prominent in the pre-2008 or in the 2008 events, where Tim Geithner, John Taylor, and others have kind of blamed or put the burden of the blame for the crisis partly on the monetary policy stance by the Fed going into 2008, being too loose for too long. It's been stressed again as a risk factor, often in the 2010s, where with the advent of quantitative easing, of unconventional monetary policy, it's been, can tell you, in Germany there was a very big bone of contention to what extent there will be long-run side effects of very loose monetary policies on financial stability. And I think for us economists and for us researchers, this is the question we address in this paper is particularly interesting and so relevant, in the sense that we do know that monetary policy affects a lot of the variables that we think have something to do with financial crisis. So there is a fantastic and very broad micro literature that documents exactly how loose monetary policy, for instance, incentivizes higher risk-taking of banks. There is, the bank lending channel, the risk-taking channel, the risk premium channel, and encourages more leverage. That's partly also the work of Adrian Shin and others. And some of these papers are mentioned here. They're by no means, the list is by no means exhaustive, but it is one of these areas, I think, in econ where very smart people have done a lot of fantastic, interesting work in identification strategies that are very convincing to document on a micro level that something happens in the financial sector when the central bank loosens monetary policy, you incentivize risk-taking, bank lending, etc. And these micro studies, however, yet do not really build up to something where we would say, on the macro level, there we can see these effects running through as well. There's one slight exception, maybe, which is a mostly theoretical paper by Frédéric Boisset and his co-authors, that also shows how monetary policy might actually channel through to aggregate instability of the financial sector. But I think it's fair to say, and I was actually at the Fed, and this is, we're not involving the Fed here, but like I was at the New York Fed when we wrote this memo about monetary policy and financial instability. It's online, it's on the web, and kind of we came away thinking, yeah, there is something, but are we sure that all these well-documented micro effects that monetary policy has on risk-taking, bank lending, etc. Are we sure that they really add up to something on the macro level? And the answer we had with Nina Boryachenko and others who were co-authors of this paper was that we're not really sure. And there's as yet no study that actually shows us that all of these micro effects that monetary policy has, that they add up to something on the macro level. And this is, okay, it was a longer introduction than necessary. This is what this paper wants to do. And this is actually born in that memo work at the Fed, where we said, like, okay, what do we know on the macro level? And we went out and started this project. Okay, so here are some of these micro-level evidence papers, and you probably know most of them. There's studies, there's evidence for banks, there's evidence for other financial markets, there's, you know, all the papers about loose monetary policy and then, you know, what's going on in bond markets, junk bond markets, etc. But there's no empirical study as of now that links the stance of monetary policy and macro-level financial instability. And this is what we're going to do here. And this is the Boryachenko et al. Memo that we did at the Fed that I mentioned earlier. So does it persistently, this is the question here for this paper, does a persistently loose stance of monetary policy increase the risk of financial instability?
Can I have a quick question? Sorry.
Yes.
I just remembered that you can't see us. I'm sorry.
So I think,
yeah. So actually, maybe I was jumping too early because maybe you're gonna answer about it right now. But I'm guessing my question is about the mechanism, because one question is there an aggregate effect, a macro effect? And then another question would be, okay, but let's say there is one. It's not very clear what the mechanism will be because, you know, it's a bit of a cheap shot. But if we're thinking about, you know, long-term monetary neutrality, it's very hard to see what exactly is the mechanism that's going to cause this long-run persistent impact. And then does it mean that monetary policy is not neutral in the long run?
Well, I mean, funny you say that because I just got back from the NBR Summer Institute a week ago, and Alan and Oscar and Sanjay Singh have this great paper on sort of long-run effects of monetary policy, where they argue that you can actually see the effects of monetary policy shocks. You can measure them sort of using local projections over much longer periods than we typically think, and they link this to stuff that's happening with productivity and capital deepening. But I think we're not going to talk about long-run neutrality here. What we're going to say is we talk about channels. So we'll present some of the channels through which we think these the monetary policy and financial instability link runs, and those will be financial market channels. And then you can maybe move on, and I think and say like, okay, so what's going wrong in financial markets? What is driving excessive risk taking, etc. And we don't come out on, like, you know, you talk then about asset pricing and questions of, you know, expectation formation and all kinds of things that can go wrong. But we're not going to approach this sort of from a monetary neutrality real perspective. We're going to say like this is linked to events in financial markets, boom bust periods in asset prices, etc. Okay. And there, I guess I'm with you to some extent, where the channel, we can give you the approximate channels. This is not the paper that, you know, this is one paper, one idea in a way, but this is not the paper that shows how loose monetary policy distorts expectation formation of agents and hence leads to bubble dynamics in house prices. Okay. That we're not going to do that, but I'm going to show you how these periods of loose monetary policy, loose stance of monetary policy, are linked to quite substantial, significant events in credit and asset prices, credit markets and asset markets. That's where we're going to stop. Why that's happening is a good question, but I think we need different set of data.
Thank you.
Yeah, well, you are. It's a great question. And okay, so when I say loose monetary policy, probably I'll use that a lot because it's shorter. What we mean is a loose stance of monetary policy. So that's a policy rate that's below the neutral rate. So R is smaller than R star. That whenever that's the case, we describe this as a loose stance. And in the empirical setup, we will look at periods where the stance was loose, so R was smaller than R star for extended periods. That's what we call then sort of a loose monetary policy, periods of loose monetary policy stance. But I'll get to the empirics. But this is, so whenever I say loose monetary policy, it's not low interest rates per se. It's the level of the policy rate set by the central bank relative to the fundamental equilibrium rate R star, and I'm going to talk about R star, which of course we need to estimate from the data, and that's a big part of what we do empirically. Okay, where are we going? Here we go. This is to, and I think I'm going to spend a minute or two on this, just because it gets you into the sort of optical setup that is needed to understand my talk and to follow without any problems. Because I'm going to show you a bunch of impulse responses or local projections, and I mean they all going to have a similar flavor to what's going on here in on these axes. So we'll have this is a simple event study. What we show is we show you an average on the left-hand side. I'm not sure you can see my cursor, probably not. On the left-hand side, the blue line is the average stance of monetary policy in the years preceding a financial crisis. And when I say this is 18 countries since 1870. So this is a very long run and broad canvas, so to say, that we're using here. And you get visually the impression that the year zero, the vertical red line at zero, is the year when the financial crisis breaks out. And just averaging in a very simple way over the preceding, the stance of monetary policy and here it's 8 years preceding the financial crisis. You know, you might be convinced by this or not, but this is just a very simple way of averaging, giving you this sort of event study-ish slicing of what's in the data. You see that the stance tends to be loose in the period before financial crisis. Tends to be specifically you lose in the sort of range of 3 to 5 years before financial crisis, and then typically normalizes or gets neutral back into the crisis. But averaging here, we get this picture, and then you see these red dashed lines, which is the US in 2007. So you might say like, oh, I don't believe I mean, I wish you do, but you might say that these estimates of R star have, you know, come with some uncertainty, especially if we go back for a lot of countries over long periods. But I might have a better understanding of what feeds into, you know, sort of the US estimates of R star for the recent couple of decades. And we do the same here for the 2008 7-8 financial crisis in the US. So the red dashed line is just the stance of monetary policy relative to, I think this is to the R star estimate. This is I think the Williams estimate here, going into the crisis, and you get the same sense, I mean, very same shape that that we find for the overall sample, namely that the average stance tends to be below neutral. Yes, please. Go ahead.
Sorry, just a minute. Yes, we have a question from Orange Nelson. Oren?
Yeah.
I listen.
Can you hear me?
Mm-hmm. I can hear. Okay. Sorry.
So your data is very, very long. What does that mean? Loose monetary policy before the Fed was invented, between, I don't know, 1913 and the 30s to Bretton Woods to like it's all very different, right? Because, for example, between 45 or post-war until 72, you have basically the same monetary policy, roughly the same monetary policy throughout the advanced economies. So you don't really have the cross-section variation for that period. And generally, I don't know, monetary policy being loose, it's not really clear what it means before Bretton Woods.
So I think there's two answers I have to this. I mean, it's actually three. First one is you're totally right. Things change over time. Second answer is we make sure, that's the pragmatic one. We make sure that our results are true for the post-1950 period, the pre-1950 period. That's not driven by any of these sub-periods. And the third answer is maybe even more agnostic. I will show you, and we can, and we will. The empirical setup of this paper is embarrassingly simple. We're just going to basically estimate a long run R star for all of these countries individually over time, and then construct the difference between the policy rate by the central bank and that fundamental neutral rate, which, you know, as a concept, I think is well defined across monetary regimes. So there's nothing wrong with estimating an R star for the gold standard period. And yes, there were periods, I mean, famously, maybe if you think about the 20s, where interest rates in some of the key economies were reasonably low and potentially even under sort of a reconstituted, maybe not perfectly working gold standard, but where, you know, you get that difference between whatever you think of as a fundamental neutral rate in the economy and the policy rate. And we're just going to very naively use that difference. And so we put a lot of faith in these long run R star estimates in a way to define the stance. And you might, you know, say like, there is uncertainty in these estimates and we account for this uncertainty. And we, you know, there's things we do around this, but we kind of really stand on the shoulder of giants because we don't invent these long run R star estimates. I will show you in a minute. We use what Marco Del Negro and other people at the Fed have done in their long run R star paper. They did it for 8 countries. We extend the methodology to 18, but it's essentially sort of, you know, standing on Marco's and Tamba's and others' shoulders and deciding this is the best we can do to sort of extract individual country R stars from the observed data in this context. So your question is well taken. I think it's cool. It's like a 3-layered answer to practically. We'll look at both periods and things hold. Technically, we think is this sound to do, and on the estimation part, we rely on what's been done. We account for some uncertainty, and I think I mean, since I've kind of heard similar, and I think that this is, you know, don't saying I'm bored by these comments, but these are important comments. So I think the way to read a lot of these long run work we've done is not to get to focus too much on whether the blue line in the year 4 before the crisis actually at -2 or -3, but just to say like, okay, there seems to be something in the data that, you know, with a little bit of goodwill, you'd say like, yeah, there seems to be something that interest rates tend to be kind of lowish before crisis at some point, and that seems to be a historically repeated pattern. I don't think we would necessarily make a point that we defend like with all we have that this increases the crisis risk by 12% versus 22%. There seems to be something that we want to be aware of, and that feeds into the policy process when we think about potential side effects. I think that's it. Let me move on the right-hand side. There is the credit to GDP ratio. Same setup, and you know, someone asked about the channels earlier. So at the same time as before crises, the stance of monetary policy tends to be loose. Before crisis, I mean, this is the credit boom gone bust story in a way. The credit growth tends to be relatively high going into these crises. So we think that or we sort of, at least there's sort of a suggestion here that these two, the loose stance and the credit boom could be two sides of the same coin. And again, the US data here, if you don't believe the long run stuff. Okay.
May I ask a question?
Of course, yes.
Did you test the complementary, or maybe the more important question, whether each time you see low interest rates, you see a crisis after that? I mean, what you do here is you take the crisis and you show that before a crisis, given that there was a crisis, there were low interest rates. But maybe the more important question is whether low interest rates predict a crisis. And
that is a fantastic question. That's exactly what we're going to do. This was the event study, and then we're going to say like, okay, we're going to see if these loose stances predict instability. We're also going to do other things. We're going to do the Schleifer et al. Red zone stuff. So these bubbly periods. We're going to predict a lot, but this is exactly what we're going to do. This was just to sort of kind of frame your intuition a little bit. Okay. I'm going to move on. Just tell you very quickly about the data, and then we can jump right in. I think at any point in time, I don't think it's conceptually a very. I mean, I've thought about this a long time. We've written kind of papers and worked on this for a long time, but I don't think it's conceptually a paper that's hard to present, because it's really clear what we do, and then I'm happy to take questions along the line about like, oh, should we have done it this way or that way? Is there a better way of doing it, etc. But essentially, take a long-run R star, look at the monetary policy rate, say the stance is loose whenever the monetary policy rate is below R star for an extended period. And I wanted to tell you about the data, which is our macro history database, which is online. You can use it's macro financial data plus three different banking crisis chronologies. So it's ours, the JST one. There is the very nice work that Emil Werner and Matt Barron did on coding banking crisis using bank equity returns. And there's also, I think we also have Reinhard Rogoff in there. So this is all robust to all of those. 18 advanced economies, very heavy on Europe because with long run data and a lot of countries, but US, Japan, Canada, Australia are also in there. And the missing element are the estimates of R star. So the natural rate of interest is the equilibrium real rate of return in the case of fully flexible prices, using Woodford's famous definition. Monetary policy, this talking to central bank audience, affects the real economy through nominal rigidities. If the real rate R is below R star, the monetary policy expansionary, and we're going to define the expansionary stance. See here this as an average over a 5-year period where we look at the policy rate relative to the fundamental, to the R star. This choice is, I can assure you, innocent, and we'll have lots of other ways. We can look at 3 years, we can look at 6 years. 5 seem to be a very good sort of middle ground, but it's not. Our results don't hinge on that. But I think important is for you to sort of remember that this is not like a one-off. It's not a 1 quarter deviation sort of monetary policy signal. It's periods where maybe a situation that speaks to the last crisis experiences in the last decades, where for a long time the stance is below the fundamental, the natural rate for extended period. How are we going to identify R star? We're going to do as mentioned, the Marco, Domenico, Tambalotti approach in I think it's the JIE 2019. We're going to identify country-specific and global long-run trends in R. It's a VR model with common trends and long-run restrictions. It's essentially a long-run asset pricing model imposing no arbitrage conditions. And we're going to do Bayesian estimation to perform the trend cycle decomposition, just as they did for 7 countries, and we do this for 18 countries. I think I'm gonna skip this just because the sort of notation is quite tedious and the slide is full. I'm happy to come back, but there's nothing here that hasn't been done in Del Negro. It's a long run estimate of country-specific rates of natural rates, how that are linked internationally through no arbitrage condition for inflation. The data look as follows, and I will show you the estimates from the red dots. Here's the estimate based on 7 countries from Del Negro et al. And we get our estimate based on 18 countries. And you see we're slightly higher on average, at least in the earlier period, which kind of makes sense if you think that the countries we add tend to be, I think, like more peripheral, not as developed countries at sort of at a stage in development where rates of return on capital might have been slightly higher. But I think importantly for what we're going to do here, we're not like this is really nothing where we can claim intellectual big intellectual ownership. The data and the R star that we get, this is the averages here, look kind of similar to what Del Negro et al. Have done before. You get in all of these estimates a relatively stable period, and we had one question on this, roughly until World War II, and then rising R star into the 70s, and then this very substantial decline going into the recent period, and there might be a slight uptick now in the data, given that inflation has made a little comeback. But I think most of these estimates would still show that the sort of fundamental equilibrium real rates are low. This is equilibrium real rates, yeah, that's important. So this is we sort of filter out so it's not nominal real, it's filter out the inflation. Okay, here's the econometric model. So left-hand side, this is as suggested earlier. The B in country I at horizon T, then plus H, is going to be a positive event, and that event is going to be a financial crisis in our baseline, but we're going to replace that financial crisis dummy with other indicators, credit market overheating from the Schleifer Greenwood et al. Paper, I believe it is, asset prices, certain parts of the distribution of the credit growth universe, etc., as you will see. We relate that the probability of this event occurring, or in this case the linear probability of this occurring, to the stance of monetary policy. And the stance bar means it's this average stance over the 5-year period. There's going to be country fixed effects. There's going to be a bunch of local and global control variables, the standard macroeconomic, everything in there, from growth, investment, consumption, etc., etc. And we're going to also look at and then present these figures on the with 95% confidence intervals. We verify the confidence intervals with bootstraps. I'm going to talk a little bit about this in a little bit, but essentially doing this prediction event, controlling for observables. In this case, it's, we're not in the causal world. We're going to get there in a moment. We're just going to relate the average stance to the linear probability of having a financial crisis. Here is the unconditional crisis probability as a dashed line, and then you see how that unconditional crisis probability in our long run sample over a 3-year horizon going forward is shaped, is transformed, is affected by a loose stance. Yeah, and you see here from a baseline of roughly 10, the having a loose stance increases the crisis probability by roughly 40%. Now that sounds a lot, increasing by 40%. So we go from somewhere around 10 to somewhere around 15, 14, 15%. You see this shape, and this shape I want you to remember, because it's going to stay with us for kind of whatever we do in these regressions. You're going to see a shape that looks very similar. At the very beginning, loose monetary policy, if anything, reduces the risk of crisis. But over time, we sort of the crisis probability, crisis risk build up and become significant and very imminent, sort of at a roughly 4 to 6, 7 year horizon is the crisis. So entering a period with a very loose monetary policies or loose stance. We also do very loose, where we look at certain distributions and the of stance, but entering after a period of loose stance, the crisis risk is measurably elevated, starting roughly after 4 or 5 years after sort of getting into the loose stance zone. That's our key. I mean, it's not the causal key result. That's sort of the, you know, just the conditional correlations in the data. I'm gonna skip all of this because it's.
Moritz, we have a question from.
Yes.
Yeah, sorry. We have a question from Itamar. Itamar Caspe.
Yeah, thank you. Question about R star. Could it be? I mean, you estimate R star separately from the econometric model.
Yes.
So, and it's based on the entire sample, right?
Yes.
So basically it's unobserved, so the model backs out R star and it views periods of high levels of activity as a boom, and that makes the model interpret R star to be kind of loose before that, meaning might it be that, you know, you get some kind of an artifact of loose monetary policy because you estimate R star throughout the sample and then use an econometric procedure that assumes that it's exogenous and it's given?
Well, I mean, we tend to think that sort of the fundamental rate, the R star, is not. I mean, we assume that it is not affected by contemporary variables such as monetary policy. I think that is right. I mean, there are some models. I don't know if that's where you're going, where people say that loose policy might also affect sort of long run real R star through various channels. I think there's some BIS papers on this, but that's not where we're going. I mean, as you say correctly, we take R star as given in any given moment with country specific trends backed out from this long run global VAR with these, you know, with long run, short run rates and inflation, and then the no arbitrage condition that comes in across the sample. But we don't account for monetary policy contemporaneously changing R star. No, that's true. In terms of growth and boom bust in the real economy, I think, correct me if you see that differently, but I think, and I think if Max is online, he might have a view on this as well, is that the growth controls, the real controls that we have in there, would take care of in the local projections in the crisis probability estimations, would take care of sort of the boom bust in the real economy.
Okay, thank you.
Yeah.
Just I want to clarify one point. I mean, when you estimate an unobserved variable and you use the entire sample to extract that, but then you use it in a subsample in order to predict something. Now, you measure that based on the information from the entire sample.
That we don't have at that point, you mean?
Okay.
Yeah. Max, if you're online, help me. Did we look into rolling window R stars? Because that would probably be the answer. I'm not sure we can do that. I'm not sure we did it, but
so in theory, we can do it, but it requires, I guess, a lot of computational power because R star is estimated by Bayesian estimation. So it really takes some time to estimate R star. So if you do it like for every year on a rolling window basis, so in theory, we could do that. So this would take a lot of time, but in theory, it's possible. Yeah. Yeah, and also as Moritz already said, we control for real activity, and later on, right, we also show kind of an reapproach where which should also like address this problem.
Okay,
that's a good point. Yeah, sorry.
Thank you.
That's a good point because I want to come to the IV, and so far, obviously this has been illustrative and maybe interesting and sort of a glorified event study, but we have to be slightly cautious on calling these effects really like driven by monetary policy, because we don't have exogenous variation our policy rate, or policymakers don't throw dice, and they set R star or R lower than R star for a reason. So there's all kinds of selection and non-randomness that's in these estimates. We're going to address this with an IV strategy. Before we get there, there's a few things I want you to just take home as call it a long-run correlation analysis of macro financial data and their link to an interest rate policy and their link to financial crises. So we look at the forecasting horizon and change that. So here in these baselines, we looked at sort of a 3-year window. We can change the crisis windows. We can take out the key sort of monetary hegemon of the time. None of this affects our estimates in a way. It's not driven by 2008. We can take the sample in 2006. We can put in time effects. We use different financial stability indicators, etc., etc. And also a logistic model. This was just a basic linear probability model, but the logistic model looks very similar. If you don't like, there's a little bit of philosophy going on in the R-star estimation world, and there's the Holston, Laubach, Williams approach that you might be also very familiar with. We can implement something along the lines of Holston et al. And things again. I'll show you the shape. I think this is also what for me really remained quite characteristic of whatever we did. And I remember having many conversations with Max along the way, like this shape of having, you can shift this a little bit around, and maybe, if you change the crisis window or you change the stance definition, this thing shifts around a little bit, but this sort of wave-like shape, or whatever inverted U or whatever you want to call this, it shifts left and right a little bit, but it looks, it's a very persistent, strong pattern that we find in the data. On impact, central banks can buy time. Financial stability risk fall. Loose monetary policy is great. It helps everyone. And then they're, like crossing a 3, 4, 5 year, the 3, 4, 5 year bar. The crisis risk is elevated and becomes, significantly elevated, peaking around 5 years after that we enter that period. Okay, let me move on and go beyond the correlations. Before, I'm going to show you something on some other outcome variables. Credit market overheating. So why does excessively loose monetary policy trigger financial stability? Well, there is, so making our way to this causality mechanism question, there is quite a lot of work on what are the short-term predictors of financial crises. Alan and I and Oscar, we've done this work on credit booms. House prices are often seen as indicative of trouble ahead, given how much financing goes into houses typically. And then there's an interaction that has been pushed both by in our previous work in the 2015 JME paper, but also in the recent, I mentioned the Greenwood-Schleifer Journal Finance that came out last year. And so we now link stance not directly to crisis outcomes, but we link the stance of monetary policy to these, what are we going to call them, like these intermediary mechanisms, these channels, intermediate variables that have been shown to be associated with financial crisis. So to credit growth, to asset prices, and especially to their interaction. Okay, what happened here? Something happened that wasn't supposed to happen. Hang on. So here we are, predicting red zones. This is now the framework from Greenwood et al. So we use the same predictive model, but we modify the outcome variable B1, where now what we predict is entering a red zone in year T, and the red zone is defined as a period when debt growth is above the 80th percentile of the debt growth distribution, when at the same time asset price growth is in the top third of the distribution. So you have a simultaneous credit and asset price boom. By the way, these percentiles, we didn't make them up. Schleifer et al. made them up. And then there is the R zone, as defined as we enter an economy enters this R zone, red zone, when these two indicator variables are both turned on. You can then differentiate the R zone depending on which debt variable and which asset price variable you look at. There's the household sector R zone, which is when household credit. I guess this is something that was very debated in Israel until recently. Last time I talked and visited, this was very strong focus, the dynamics in housing and credit markets. But you can also do that for the business sector, where business credit and real stock prices are the two, sort of the credit and the asset price variable that get interacted. And in the next slide, we're going to essentially do the same that Greenwood et al. Did, by looking at the post-World War II period only. That comes back to the very first question: is this stuff that you're doing here, robust across time, where we know things have changed so much? And the answer is going to be yes. We're predicting post-World War II red zones here for the household sector and for the business sector. We also have the overall red zones. That's kind of the low-hanging fruit. But especially for the household sector, you see again this shape where the forecasting horizon here starts 2 years out. We're 2, 3, 4, 5 years out. Loose stance makes it much more likely that the economy gets into this sort of overheated sector where both credit and asset prices are growing very strongly. Results are slightly less sort of nice for the business sector. You still get this nice shape, you still get an increase, and you still have some level of significance, but there seems to be much more noise. And I think we think that this is owing to driven by the volatility of stock prices. So these business sector R zones are just slightly noisier, but the shape, if you look at both, still kind of comes through that. The financial stability risk of loose stands build up over time and then peak out around 5 years or so. Again, we could do this for very loose MP, but very loose monetary policy. But I come to the I reserve my time for the IV. So what we have in the paper, we have robustness and extensions. We have results based on the full sample. Remember, I just showed you post-World War II, so we can really do the Greenwood et al. Exercise. We can add decade fixed effects, money growth and inflation, logistic models, etc., etc. That again, I think the way we think about this, I mentioned it, and I'll say it again, is not, we're not married in any way, romantic or not, to these parameter estimates, in the sense that it's that we'd say like, oh, the crisis risk or the R zone, the red zone risk goes up by 34.5%. The point is that we think this is something that the profession and central banks should know. There is something in the data. Again, this is not the causal part yet, but there's something in the data that if you buy into some of these assumptions, R star concepts, the estimation method, etc., then you come back seeing these shapes where a loose stance over time in a statistically significant way increases crisis risk somewhat. And if that somewhat is, for your taste, large, small, should be something that should guide the hands of policymakers, is a question that we can't answer here. There are difficult trade-offs. There's a growth trade-off maybe that we need to think about. But it's something that we feel comfortably sort of, pushing out. There is on the macro level, at least long-run data, and mind you, we'll have to wait. This is the near universe of long-run macro data that we have. So we will have to wait a long time to overturn these results. Just because this is sort of what the modern economic experience seems to suggest, that this is, so far it's there, and the broad patterns seem to be there. There's a question now. I see a hand, which is good. So I'm getting more of a Teams pro here.
If you're going one slide
Back.
Before this,
hang on, here we go.
no, the graph.
One more,
Yes,
this one.
the graph of the red zone.
Yeah, this one.
Yes. What is how you explain the decrease in the long run of the red zone for the household sector after 10 years?
That's an interesting question. I don't think we have a very good explanation. I guess there is a this is the probability of entering a red zone, and this probability just becomes very low after, you know, having an increased probability of a crisis, hence having been in a crisis state.
Okay.
It tends to be kind of unlikely to enter another asset price boom.
Okay.
Maybe the last decade is the exception to the rule. I don't know, but yeah, I mean, this is. I think this is as far as I can think here. We need to think about this more. It's a good point. It turns significant after 12 years, and I guess it's the bust of the previous one.
Okay, thank you.
Cool. Now, good question. Okay, instrumenting. Now comes the our instrument of choice. I mentioned Alan's and Oscar's and Sanjay's really nice long-run monetary policy paper that they presented at the MDR a couple of weeks ago. Uses the same instrument. We've used this instrument before. And we're going to use the so-called trilemma IV. What's the trilemma IV? It's the simple, well, simple. It kind of gave Mundell a Nobel Prize in a way that in monetary policy under conditions of capital mobility and a fixed exchange rate, essentially is set by an external base country. Yeah. So if you think about Denmark, Denmark is pegged. The Danish crown is pegged to the euro. At the same time, Denmark is highly integrated into the European economy. There's capital mobility. So the Nationalbanken in Copenhagen, they do set interest rates for Denmark, but you might say they effectively do what the ECB does on the same day, given that there is this no arbitrage condition if these rates would diverge too much. So what this means is we think it gives you a nice instrument for monetary policy shocks, if you will, because mostly the base country, historically, that's the US, that's in the post-war period in Europe, Germany for a while, that's the UK and the gold standard. That base country often famously doesn't really care much about the economic conditions in the countries that have a peg with the dollar or the pound or the mark. If you think about, I think a famous case that I can still remember somewhat vaguely is the European exchange rate mechanism when the British pound was kicked out in 1991 of the ERM, and the Scandinavian financial crisis happened. That had a lot to do with the Bundesbank raising interest rates very sharply after German reunification. And then that kind of spread to all the other countries in Europe and came as a policy shock there that was unrelated to the economic conditions at the time in the UK or Sweden. And so if you buy that mindset, that's the trilemma IV. That's the IV we're going to exploit. We're going to say that base countries' interest rate decisions do not take the economic conditions of the pegging country into account when setting interest rates. We're going to purge the policy decision in the base of observables as well. So that raises the bar even a little further, because you might say, like, well, you know, the Danes still observe what's going on in Frankfurt, or the so we're going to purge that of the observables and say like that the residual there is the shock for that country. Let me show you how this. Oh no, why does this always happen? I don't know. Sorry about that. So this is the way we would instrument the stance then for the pre-2008 Eurozone. So just going back, so this is the identification assumption is if you're pegged, then you don't have your own monetary policy. So movements in your monetary policy are kind of exogenous to your economic conditions, especially when the base country doesn't look at it. So we're going to instrument the stance now. with and differentiate between, I mean, in the census for the Eurozone, we differentiate between core and periphery. So you see here for the core, the stance of monetary policy going into the 2008 crisis, because the ECB in Frankfurt set policy for Germany, France, the Netherlands, and Belgium. It didn't set the stance of monetary policy with the periphery, with like what so-called periphery, Italy, Portugal, Spain, etc. in mind. So you can see here how the stance for the core is actually slightly hawkish, even a little neutral at best at the turn of the millennium. But the way this gets imported into the periphery by the trilemma, the trilemma constellation, is that the exogenously, we would argue, the periphery had a very loose stance. So we're going to exploit in the IV setup instances where driven by monetary policy choices in the base country. In this case, it's sort of the Euro core and Frankfurt and France and Netherlands and surroundings. In other cases, it's the UK and the gold standard. It's the US during much of Bretton Woods. And say like, okay, what if we just look at a highly negative loose stance that is driven exogenously, at least remotely, maybe you let me use that word, remotely, by the monetary policy that's done in the center or in the base country. And so we present these IV estimates where we instrument stance with the monetary policy in the base country, assuming that's exogenous and not paying attention to what's happening in the domestic economy. And we can come up, if you believe that, these assumptions, at least to some extent, that this is maybe as exogenous as you get in monetary policy setups like these, long run, cross country, then we can present these IV estimates for the linear probability model stance on crisis risk, effects of stance on crisis risk. And you see that not only that shape remains very, I mean, I want to say nice, it's a crisis graph, but this shape remains in place, but also these point estimates become much larger. Yeah, so the effect becomes much bigger relative to that baseline 3-year crisis probability of around 10, 11, 12%. We now get in these cases where stance is sort of exogenously loose. If you believe that experiment, if you will, then the crisis risk, almost triples, or at least doubles at least, and is significantly raised. So we think that picking these sort of exogenous periods in modern economic history where the monetary policy stance was loose very much strengthens this sort of macro insight coming from our paper that loose stance has measurable, and I would call them medium term is maybe a broad word, but like on impact, the direct effect is to lower crisis risk, but there is a pushback coming. There is a day of reckoning coming, and 4 or 5 years out after having stance very loose, the crisis risk is very elevated, and here points that there's attenuation bias in the OLS. So here in the IV, we really get these very strong, also it's quantitatively strong effects. No, it's almost tripling of the crisis risk relative to the relative to the sort of neutral setting. Very good. There's a question from a car. No, it's not. Okay, sorry. It's just on. Okay. So next one is do we see the same the R zone dynamics in the Eurozone? Again, instrumenting stance, you get these sort of few core periphery differences, household credit, business credit, sort of as a stock price of these differences. And here's the IV estimate. So here's the IV estimates coming out of this motivation. Is again household sector and business sector instrumenting stance. Similar picture. Household sector very. I mean, I don't want to say very. I want to be cautious, but nice. Reasonably tight confidence intervals. Same shape. You always get this inverted U. With the business sector, it's slightly less precise, but again, here we see some increase in the R zone, the probability of entering an R zone down the road. Okay, so the final question is, I could show you this for the full sample as well, but maybe we get there in the discussion and have some more time to come back to these things. Let's ask that the loose financial conditions may not be a bad thing per se. That's what so you get a short-run boost, but you get these negative medium-term effects. And what we kind of ask here is, do these financial market events that we've predicted so far, or tried to predict, and even in the causal and the IV estimates that we try to make the point that these relationships could be thought of as sort of as difficult as causality is in macro, as some causal relationship. Do we also get the same picture when we don't look at a financial market outcome variable, but at what we might be interested in the end about the real economy, low output growth? So we're gonna look at two indicators. We're gonna look at periods of low output growth, is when the next 3 years of output are in the change in the output are in the lowest 20th percentile. So do periods of loose stance also predict bad macro outcomes down the road, or is this just a financial story? And we also use Barrow-Nussbaum's economic disasters, which are peak to trough falls in real GDP of at least 10%. Yeah, so we're going to replace the financial left-hand side with a real left-hand side. And you're going to see that the probability, what we estimate here, and entering on the left-hand side and getting into the lowest 20 percentile of output growth. Again, this is all for these 18 countries, country-specific, country-fixed effects, etc. in there, or entering into one of the Barrow-Nussbaum disasters. Both are statistically significantly higher after a loose stance than otherwise. So the baseline probability for Barrow-Nussbaum disasters, so for 10% real GDP falls, is 3%. After loose stance with monetary policy, that's 4.5, maybe getting up to closer to 5. Still low, but a significant increase of the baseline probability, and very similar for the low output growth situation. Again, you get this similar shape of the curve of the impulse response, if you will. Not much at the beginning, if anything, maybe slightly lowering the risk of having a real disaster. Over time, risk build up, and the real disaster risk is significantly elevated.
Moritz?
Yes, first.
Yes, we have a question from Eliezer Bronstein.
Please.
Thank you. Yeah, just a small technicality. So in the previous slide or two before, where you showed the IV estimate.
Yeah.
So, I mean, in all of the figures actually, but here I was wondering about the unconditional line, which is like about 10% risk of the crisis. Is that weighted average of when monetary policy is loose and when it's not loose? I mean,
yeah, I think this is the cumulative 3-year crisis risk at the mean stance of monetary policy, if I'm not mistaken. Max, if I'm talking nonsense, please jump in. But I think that's the so the mean. This is the crisis risk at the mean of stance over a 3-year period. So I think the unconditional 1-year crisis risk in the sample as a whole is roughly between 3 and 4%. So over a 3-year period, cumulatively, you have probability somewhere between 10 and 12%. And I guess when I say unconditionally, I mean this is just at the observed mean of stance. Is that correct, Max?
Yes, that's correct. Yes. So maybe I should emphasize that we could also show simply estimates of beta, And then these estimates would be around 0. They would have exactly the same shape. So everything is simply shifted upwards by 10.5%, but it's just for illustration. And also the nice thing, I think, is that the stance of monetary policy, right, is on average very close to 0 in our full sample. So you can also interpret the dashed line as the crisis risk when the stance is neutral.
So maybe I misunderstood, but and also maybe even if I'm right, maybe quantitatively it's really small, but to compare the effect of loose monetary policy, shouldn't we compare the 25 or 26% that we see here at the peak to something that is lower than this dashed line, because we want to compare when monetary policy is loose to the case where it is not loose. So the unconditional has also a component of loose monetary policy in it, if I understand correctly.
I think that's true. I think that, I think your analysis is true. Whether we should pick a different benchmark, you would say we pick a benchmark of.
Let's throw the periods.
But I think stance is around 0, right? So this would be almost like an approximation of the risk of a financial crisis when stance is 0, meaning R is always equal to R star. So in that sense, it's probably close to what you have in mind, no?
Yeah, could be. Okay.
I mean, we could compare to tight monetary policy, but then the question is, like, I guess one could do this exercise with you know, if you run very tight policy, does that also increase the crisis risk? I don't know. I think we haven't looked at that actually. We should maybe give us a test for asymmetries or whatever in the data. That could be that.
Okay, thanks. Thank you.
Very nice, very good question. Very enjoyed this. I mean, this is the Eurozone parable, and let me come to the end. I mean, I think we are getting to the end. Do we have? It's 5 past. Should I come to a very abrupt close?
Yeah,
now?
sure.
Yeah, okay.
Yeah.
So then I would just say thank you for your time. This is what we want to do in this paper, and I hope we got a little bit across to you in the sense that we think this is the first long run, so very basic macro evidence that the monetary policy stance has is linked in the macro data observable to financial stability risk. I am very because I have this sort of macro mindset, I'm really excited about this because I've read so many micro studies that always told me something about bank risk taking or this and that, portfolio reshuffling and what financial intermediaries do when monetary policy cuts rates. But I always wanted to know, okay, and does this matter in the aggregate? And I think this is the paper that we wanted to write, is we think it matters in the aggregate in terms of elevated financial crisis risk. And we can link it to these intermediary channels, credit markets, asset markets, as the question was at the very beginning, and also to the sorts of bad growth outcomes and bad real outcomes. So, you know, there's no free lunch, I guess, is the overall title of this paper. Loose monetary policy. Central banks do it for a reason, loose stance for a reason. And we can't talk about the trade-offs. Maybe you still want to be loose and run this higher risk of a financial crisis because it saves you on other margins and it really keeps the economy. And you know, this is not statement about optimal choices that central banks make, but there is a cost, and I think this is an immeasurable macro cost in terms of financial stability risk. I think leave it here. Max, do you want to add something that I have grossly left out? Feel free.
No, I don't think I have anything else as in mind. So from my side also, thank you for the questions. Yeah.
Okay. Thank you very much, Moritz, for this very rich presentation and paper. So please raise your hand if you have any questions. So we have a question from Gökhan. Gökhan, please.
Hello, thank you. Very interesting paper, very interesting presentation. Thank you. I have a question about the first part, I guess, where you have the R-star estimate from a first model and then you use it as a regressor. But do you account for the uncertainty of the R-star estimate? Because I guess depending on which draw you have of the R-star, the stance might be expansionary or contractionary, I would assume.
Yes, excellent question. Gökhan, this is a really cool question. And we have looked at this partly because we were made to look at it by very competent referees. Max, this is your chance to shine. We've looked at it, you've spent so much time with this that you can give the much more sort of hands-on answers. So please do.
Yeah, so Moritz already mentioned that we also compute confidence intervals based on bootstrap standard errors. And we showed this in these shaded areas you saw on some of the graphs. And the idea of this kind of bootstrap procedure is the following. We try to take this first stage uncertainty in the estimation of R star into account. And we do that as follows. We draw bootstrap samples from the data and from the 50,000 posterior R star draws. And we do that 1,000 times. So we create 1,000 bootstrap samples. For each bootstrap samples, we draw different posterior R star estimates. And based on this procedure, we construct confidence intervals. And in this way, we take this first stage uncertainty into account when we estimate kind of this second stage model you see on the slide. And on this slide here, the bars show conventional 95% confidence intervals, and the shaded area are these 95% confidence intervals based on this bootstrap procedure where we take the first stage uncertainty into account. So this is very heavy computationally, so we only do it for our main results, but we check that the confidence intervals based on the classical approach and on the bootstrap approach leads to more or less similar confidence intervals.
Okay, I see. Thank you. But like the shaded areas on average seem to be a little bit smaller than the others, which is surprising, right?
Yeah, so here they are smaller. In the IV estimates, they are larger. Right, so here they are larger. So we haven't thought about why they, yeah. Mm.
Okay. Okay. So I was curious, yeah. And
I mean, they get larger down out 7, 8 years. They're also smaller at the beginning. So it's an interesting point. We need to understand that bootstrap these confidence intervals a little bit better. It's true.
Thank you again for the presentation.
Well, thank you for being there and listening.
Thank you very much for your replies. So we have a question from Nimrod Cohen. Nimrod?
Hi, thank you for your lecture. Interesting about the other control variable in your procedure. Or I miss it, or maybe you didn't show us.
Hang on, I'll show you. You know, I've like 1 out of 3 times that you have an online presentation and you click on some button in the LaTeX presentation, something funny happens. Here we go. It worked. So we have the annual changes from year T minus 5 to T of log real GDP per capita. So it's growth, it's inflation, it's exchange rate vis-a-vis the dollar, it's the investment to GDP ratio, the credit to GDP ratio. There's a bunch of global controls as well, which is, I mean, so we have R star, we have the long run minus the short run rate. So there's a kind of if you will, the yield curve control. There's global controls, debt to GDP ratio, bank capital, non-core funding ratios as unweighted averages across countries. So we're going to control for the, you know, as crudely as it can be done for the state of the international global banking system. We can also just run time fixed effects and we get very similar results. So that's an alternative that we throw in. If there's something you think that's missing, I think we're happy to throw it in. We haven't.
Maybe I read something lately about other policy like regulation or macroprudential policies that may influence impact the probability?
No, absolutely. I think this is a point that keeps on coming up, and I think the way I see it, the way I understand your question, and the way I think about this, and this is something I have thought about, is maybe you're saying the impact of loose monetary policy on financial stability risk, or maybe even on real outcomes, might depend on financial sector regulation. It might depend on third factors. And yeah, I mentioned the NBR, the Summer Institute. I presented another paper on liquidity interventions by central banks, and that question came up as well. And I think it's a very valid question. The only good answer I have, we don't have these data right now for the long run. The only good answer I have is that we have Max, and Max is working on a paper trying to code long-run banking regulation to exactly address questions like that. I think we focus on the mortgage market in that paper, but I agree, these questions come up, and we need it as a control variable for sure, and to look at potential interactions. But I think it's also just generally it's a big gap in our understanding of financial stability and so macro financial dynamics. What role do these different regulatory regimes make? And we typically only have data, even for deposit insurance, we only have data for like 30 years or so. In the spirit of this line of work that I've been doing, and Alan and others, sort of using long-run macro data, using all the data we can, it would be very helpful to get sort of quantifiable indicators for financial regulation. So I'm on your side. We don't have it yet.
Thank you.
Okay, thank you very much. So we have a question from Anton.
Thank you. Thank you very much for this brilliant presentation. I have a small question about the household's red zone.
Yeah.
Does the probability of getting into the red zone become zero when you are already there? I mean, if it's predictive, or does it become one? That strong fall in the probability may be due to...
Obviously, you're in one.
Sorry?
That's what you mean? So we got, where's the, hang on, where are the red zones? Here, those, you mean this sort of decline out there is because you are in there with a high probability. Max, what's the forecast prediction? I think we're predicting 3 years out, no?
Maybe the household's behavior have a stronger predictive power than you have 5 years here before the crisis when they change behavior,
and then we go down again because they have had the experience and they drop out of I think that's
because you are already there in the red zone. Yeah.
Because you're already there. And then I think that could be an explanation for that. I think we're going to look at that tail here and try to understand it better. I have to think about it. That's a good point. So once you're in the red zone, I don't think we drop them. Okay, yeah, good point. I need to look at that.
Thank you very much. So now we have some 10 minutes, around 10 minutes to talk about some policy discussions and maybe policy questions related to your work or maybe simply your knowledge as a specialist of policy and policy questions. So if any of the attendees have a question, please raise your hand. Thank you very much, first of all, for your presentation. I may have one question. You know, and you talked about that previously, is the current situation in Israel, but in general, when we want to analyze a country, not necessarily with financial instability, but more with political instability. So how would you link your paper and paper recommendations to this situation?
Not 100% sure I do understand. So Can you so you want to say about how political instability interacts with financial instability?
With monetary policy, yes.
And monetary policy. What can I say? I mean, one answer that I can give you, I'm not sure it's going to 100% keep you happy, make you happy, is obviously the political instability often is a function of financial instability. I think that's a very strong, but very kind of robust result that once you're in a financial crisis, you can expect to have some political bad things happen. That's typically that. If you look at the ex ante, how does political instability affect in conjunction with monetary policy choices, financial stability risk? I mean, I think we need to then look a little bit more into what we mean by political instability. I think if you think about like military conflict wars, it's pretty clear that those are major shocks that have ramifications for the financial system. You know, we had banking crisis at the beginning of World War I. You know, and sort of we've seen it now again with you know, there's always a financial like if financial transactions get interrupted, there is a knock-on effect on lending, etc., and central banks typically have to step in. I think we also had a little bit of a in the UK last year with the budget and sort of the mini crisis. We had a feeling for, or we got a feeling for, to what extent I think fiscal policy choices can very quickly lead to have repercussions on financial markets and then bring down financial institutions, etc. No, I mean, I think there's various interconnections. The work I've been doing recently is sort of gives you an indirect answer maybe to that question, which is a lot of work in other than this project. Most of my time was spent on a project trying to find out whether lender of last resort operations during crises are beneficial, or whether the moral hazard argument, like you save banks, you invite more risk-taking next time, whether that wins over the stabilization argument that you cut short inefficient, you know, non-fundamental runs, Diamond Dybvig style. And the result that comes out from that is that indeed lender of last resort operations, sort of central banks coming in, stabilizing financial markets in these run-like situations and crisis situations, and they can be triggered by politics or by, like, you know, the thing about Liz Truss in her budget a year ago, that there is a big beneficial role for central banks in shortcutting so these inefficient run situations. I don't know if that helps. I mean, if you have it a little bit more specific, I'd be happy to try a little bit deeper.
Thank you very much. Yes, maybe we'll talk after the seminar. It's very interesting. So we have 3 questions. So Nimrod, yes, Nimrod Cohen.
Hello,
thank you very much for
again.
your reply, Moritz.
Quite a general question, but I think maybe you have idea because all the data and all your experience. How do you identify financial crisis? Yes, how you identify a financial crisis, and how do you identify it in real time, let's say, if you understand.
Oh, I see. So I think there's 2 dominant ways of identifying financial crises. One is the narrative historical identification. I think Reinhard Rogov, but Barry Eichengreen and others have pioneered this. And that is indeed kind of an ex-post classification. You see it, you know it when you see it, and then smart people talk and write about it. And then you have sources to code it from. That doesn't help you as a central bank decide in real time. And in real time, I think the best we have is what Emil and Matt and Wei did. So the Baron Werner's Young paper, the BVX paper, which essentially says we think we are in a banking crisis, we have the financial stability issues if the equity, this market capitalization, the stock prices of banks fall by, and then you can, I think they do 30% if I remember correctly, fall by a very large amount over a short period. That is a signal that stuff is happening. And I'm not speaking for the Fed, obviously, and none of this is, but you can see that somehow there is I mean, it's not the reaction function of the Fed, but it is something of central banks generally. But there is usually a lot of denial, but of course people watch what's happening in the stock market, and people watch especially what's happening to the share price of banks as an indicator of what. And I think I guess that's what I would do in addition to looking at funding costs and OIS spreads and all of that stuff. The finding of Matt and Emil and Wei in this paper is that the stock prices are kind of leading. They're 6 months typically before the run situation. So if you think about Silicon Valley Bank, for example, it wasn't too
price of financial institutions.
Yeah. So if you think about Silicon Valley Bank, it wasn't too bad. It wasn't, you didn't have months, but these stock prices were very battered already long before then the run actually took place. No, and so I think in situations where you and I guess the reason why you want to look at stock prices maybe over credit markets is that to the extent that you have some too big to fail backstop, creditors typically don't lose a lot. But as in Silicon Valley Bank, the equity holders still get wiped out. And so the equity market is very fickle, and it's probably the best leading indicator we have for that, I would say.
Sure. Thank you.
You're welcome.
Thank you very much for your questions and responses. So we have another question from Gökhan. Yes, Gökhan?
Yes, thank you. I mean, it's maybe a general question, but also can be specific to your paper. But so you must have seen this paper from Marco Del Negro and co-authors, the financial instability R***.
Yeah, I was there when they wrote it. Yeah.
I mean, in general, does it also make sense to you to define, for example, the monetary policy stance with the difference of the real rate to this rate? And would it be possible for you to check this in your paper just for the US? Of course, I think they do the estimates only from 1975 or something like that, but.
Yeah, I mean, I had a lot of quite a few discussions with Marco about this and co-authors. I do really like the paper. I think it's a nice idea to integrate that aspect of what central banks are about, and this sort of mandate that's been at the origin of central banking, almost financial stability, and it somehow got written out of the statutes, and now we're trying to get it back in. I think it's a very valid conceptual way. Way to think about it and integrate it. We haven't thought about sort of testing or extending this beyond the I think the US sample that they use, which doesn't mean that we shouldn't try that. So I guess the bottom line is I'm a great fan of the work. I think it's much more of that is needed in the sense. I mean, Max and I have some work on the yield curve, for example. I think we still, despite all this like decade or 15 years now of very intense financial stability research, there's still always things that, I mean, there's two things that come up. First, I think on the empirical side, we still don't know everything. There's still a lot of things we wake up and say like, oh, this is actually quite major. How's it that we didn't have this on the radar before? And here I'm thinking about like, well, the recent work we do on how the yield curve is predictive of financial instability and through what mechanisms, and how this is linked to over-optimism of lenders. But it's also the fact that conceptually we are not very. I mean, I guess partly there is this big block in the way, which is that macro models without rational expectations become very messy, and we haven't made much progress in sort of behavioral or like all kinds of macro thinking where. Well, let me say one fact, for example, is I think it's a very strong fact of the financial stability research that over the past decade has come out, is that during credit booms, the risk goes up, but the price of risk goes down. So just at the time when macroeconomic risks are rising, in terms of crisis risk, growth risk, whatever, and you looked at disaster risk, or you could look at the whole growth at risk stuff, just when fundamentally the risk in the economy is rising, typically the price of risk in financial markets is falling. Now, maybe there are smart ways to get this into sort of a intermediate-based asset pricing model with where constraints loosen, etc. But I think the Occam's razor, the first order thing is like something is wrong. People are too optimistic and they don't see it coming, and there is a behavioral aspect, and there's a bad belief aspect to crises, and we haven't. I think people are still out there waiting sort of for the killer app for behavioral macro to enter into mainstream macro, and financial instability might well be the one.
Okay, I see. Thank you.
Could it be because sorry, I'm hearing myself twice.
I think there's an echo.
Now
Yeah.
you can hear me. Could it be because we're measuring the price of risk using backward looking information, and if we looked at expected returns, then that would not be the case?
I think the work, I mean, if you look at the Baron-Xiong 2017 QJE, it was a 2015, it would suggest the other way around, no? That people don't see it coming. It's not priced into expected returns. It's a valid question. My reading of the literature is that a lot of the expectations formation literature, a lot of that empirical stuff points to these. I mean, this is basically the Schleifer agenda. No, this is the sort of points to these regular mispricings, if you want to call them, over optimism, neglecting of crash risk. And if I read the Baron-Xiong paper correctly, they go to that question: are these risks priced in ex ante? Are investors compensated for the extra macro risk in the real time? The answer seems to be no, but in their paper.
Thanks.
Thank you very much. So we have another question from Pavel Schmaklik. Pavel?
Yes, hi.
Hi.
So, sorry, I can hear myself twice.
I can mute myself.
Oh, it's for me. Yeah. So I have a question about the current monetary policy environment where we're looking at a more tightening regime. So I was just wondering if you looked at the reverse question of like, when do you have policy that's too tight that might bring into something that's more of a crisis? So obviously there's contraction, right? But to some level of a crisis. And I think it's interesting with the current, like, it's been more than a year now of like this soft landing talk, right? So you can talk about soft landing versus hard landing. I'm just curious if you like toyed with this, or how prevalent you have hard landings in the data or something like that.
That's another great question. So thanks so much, everyone, by the way, for making us think hard here. So I have two answers to, or like 1.5 answers to this. The first is, we did a paper, it's out in the AER Insights a couple of years ago, where we show that against the condition, we use the same trilemma IV that we use here to instrument the stance, and we show that when you're in the credit boom or in an asset price, an economy is in an asset credit boom situation, and you get surprise tightenings, large tightenings into the boom, the crisis risk shoots up. Because you apparently, I mean, I guess my interpretation would be you really change expectations. People, financing models are no longer working, and you trigger these crisis dynamics. Now, what you say correctly is what we have done, what the ECB has done, the Fed has done over the last 1.5 years, is a massive amount of tightening in a very short period, and there aren't. In our data set, I don't think there are many. There's like maybe 1 or 2 examples where central banks have changed policy rates as quickly, as strongly in such a short period of time. And then depending on how you think about, the savings and loan crisis in the US under Volcker, etc., you say like they were associated with crises or not. But so I think this interest rate risk thing that we've seen with Silicon Valley Bank and that is, that's a common feature, I think, in these rapid tightening responses. But I think the crucial point is if you combine these two bodies of work, the one on tightening into credit booms makes crisis more likely, and the other thing about what we're observing right now, that we have had an interest rate risk, but not so far like a systemic solvency risk, gives me. I mean, I'm jumping very far here now, but I think it tells you that that the credit boom, the bubble thing is important. So and we might get away this time with less damage simply because we didn't have such a big credit boom going into this, especially on the household side. In most countries in Europe and even in the US, households were more or less deleveraging. Certainly, there's some crazy stuff that happened on the corporate side, and maybe we get some pushback there eventually. But overall, I think we are in a world where, I think central banks have done a lot and probably even enough for now. But I think we are still in a world where interest rate risk, Silicon Valley Bank risks dominate. I don't see the systemic solvency risk, at least not if asset prices, in particular house prices. We've seen, in Germany we've seen a correction of 20% in real terms now. I don't know about Israel, but if asset prices remain in that area, and most of the correction happens via so the losses through inflation as opposed to nominal price decreases, I think we're okay.
Thank you.
Thank you very much for your questions and for your replies, and especially for your presentation and the fantastic paper, Moritz. So we were glad to hear you, and thank you again for attending and presenting your paper, and thank you to all attendees.
Well, great thanks to you. Thanks for having us. It was a great pleasure.